Hi, Matt McAleer, Director of Equity Strategies, September 24th, just after the close. The Moose is back in town, so the Matt and Moose show rolls on. First thing I want to take a quick look at is a continuation of a chart we looked at last week. The equity market this week showed plenty of volatility, but what jumped out at us was the strength in energy, banks, and insurance companies. Really, that was the result of that move higher in interest rates, which John will get into. Last Friday, and I encourage you to click on the link to go back to last Friday's video, we took a look at a point and figure chart of the 10-year Treasury bond. The 10-year bond was pushing up against that 1.375 area. It was the fourth time it had done it. Each prior time it had pulled back, making a higher low. The fifth time it worked through there, and as you'll see on our new chart with the yellow line, the yellow arrow rather, we've worked our way through an area of congestion, and that continued. We ran all the way up to 146 today. Last week we said from an equity side, what adjustments do we need to make if rates were to go higher? And we saw it this week. We saw strength in financials. We saw strength in energy. We did get a buy signal in our quant strategy on Monday. So we got long the S&P. But just as important, one of the sectors that we rolled into off that signal was energy, which had a very nice week. This is just an example of how multiple asset analysis can lead us in terms of weighting and allocating capital in the equity markets. So we'll continue to keep an eye on that bond market, and John can give us some color on it right now.
Sure, thanks, Matt. It's nice to be back. Funny week. You look at the 10-year Treasury, 136, ended at 146. Look at the 30-year Treasury, 190, ended up at just a smidge under 2%. So both up about 10 basis points for the week with some volatility in there. But it's interesting because if you went back just beginning of August, that 10-year Treasury is around a 120, so it is moved up. What's different this week is the backdrop to how it moved up. If you look at the beginning of the week with some of the problems in the equity market with concern about Evergrande, you think about that, and normally you would see a run into treasuries that would be very solid. Didn't see it. 3 or 4 basis points, that was about it. Normally that could be a 10 basis point day, downward in yield. So we didn't see that. The other part was we saw the Fed keeping short-term rates where they are, but the Fed finally discussing tapering, which means pulling back from the $120 billion per month of securities they've been buying. And that goes down to about $80 billion in treasuries and about $40 billion in mortgage-backed securities. Fed's not saying when they're going to start, but they said they are going to start, which means they are recognizing that the economy is now at a point where they can start to pull back. Clearly, the bond market took its cue from that. Yields have moved higher. Muni yields moved up only about half as much as treasuries. They're about a 70% yield ratio on AAA securities. When you look at the muni side of things, though, when you start this movement, we think you'll start to see issuers now in basically the last 3.5 months, last 3 months of the year, really push to get issuance out there. Because if we start to move up in rates, we'll probably continue to move up for a while. Remember, we were at a 175 last March, and inflation really hadn't taken off yet. Now we're looking at year-over-year inflation numbers of 4 to 5%, depending on whether you're talking about headline or core. Depending on where it settles down, you know in the long run that the markets are not going to accept a 1.5% 10-year Treasury when you have a longer run rate of inflation of 3 to 4%. There'll be some adjustment. So in the long run for bond investors, this rise in rates is pretty good.
That's what you've been looking for, a little rise in rates, some help on coupons, some help on yields.
Right.
We have clients that look at their bonds as yield instruments versus straight trading instruments. So we don't mind a little boost higher in rates.
No, we don't want it. And a gradual rise in rates is actually good for bond investors over time because the reinvestment rates go higher. You know, in the market that we've been in, we haven't seen a lot of trading activity opportunities because so many bonds are at book yields or original purchase yields that are so much higher than the existing market.
You keep them.
That you just keep them. That's exactly right. You keep them.
So it'll be interesting to see, with a little tailwind on yields now, if we have to continue to adjust our equity portfolios to include some of those sectors that react well. If we go back to last September, go back a year, remember when rates started moving higher off of that real drop when the Fed took rates to zero during COVID. When rates started moving higher, what worked? Small caps, mid caps, value. So if you're predominantly growth anchored in portfolios, give some thought to supplementing those growth names with some value names. Enjoy the weekend. We'll see you next Friday. One thing we know, it'll be interesting.